All right, welcome back. Our conversation on the state of the economy and what it means. Ladies and gentlemen, we're joined by my panelists who are still here with me. We started off the conversation. Rose Mara is the chairperson of the Public Finance Sector Board at KEPSA. Kwame Owino is an economist. And we also have with us Solomon Kihanga, who's a senior manager, tax and regulatory services at KPMG. Kwame, you explained what that inflation rate means, that the price of goods is still going up by 2.7%, but that perhaps the rate of the increase is reduced. But are there times when we should be excited about inflation rates going down? And how would that manifest for us?
Yeah, I mean, we should, except that the one we are witnessing is very peculiar, as you can see, for the first 2.7 in 16 years.
Yes. And
it's also peculiar because if inflation rates are going down and growth is going up, then you actually can tell that everybody's buying power is really increasing. But as you can see, again, based on Kenya National Bureau of Statistics data, the third quarter, the quarter that we just started when inflation was at 2.7%, is also the weakest in terms of growth since the COVID period. So that combination cannot be good news. So that's the other thing. But it's already showing us that inflation is far too low. It's close to the bottom.
Yeah. Is there a time when that's dangerous?
Well, yes, there is. I mean, look, inflation simply means prices are going up.
Yeah.
So if you look at the inflation basket, there are two things. There's a non-food component and there's a food component. Mm-hmm. The food component is still unprecedentedly high. The food component is 30% of it. It's the prices of food. So prices of food, in total, some food prices are going down, but many of them are still going up. So food is still expensive. Yeah. And remember, food is something people have to buy while their incomes, as you already showed, are actually falling. So the difficulty in just meeting daily demands has not dissipated, even as inflation is down. In fact, if you look at it, the items that should worry us are the items at the lower level, I mean, the non-food items, and that non-food item part is already below the inflation target. And when your inflation target for the non-food items is already outside the range which the central bank and monetary policy is supposed to, that's still a policy failure. In the sense that you're actually having too low inflation. And inflation can go too low where it then means that, look, there's no demand. You see, part of what can make inflation fall is because there's no demand. So the food and things are available, but there's no demand for it.
And if there's no demand, because people
have no income.
Yeah.
So if people have no income, the demand falls. And it's also telling you some of the demand for non-food items come from the investment side. People are buying housing, people are buying, rents, for instance. If rents are falling, it means somebody's rental income, which the KRA,
yes,
is supposed to be part of the taxes. And it's already showing. So if you see the non-food items falling below target to a very low rate, and it's affecting government's own incomes. I never care much for government's own incomes, but if it's falling, yeah, it means that the deficit will actually could get much, much wider. So there's a range, and in Kenya, the range for inflation is 2.5%
to 7.5%.
To 7.5%.
Yeah.
What we are having, if this pace continues by the end of this year and into February next year, it will be much, much lower. It will be like at 1.7%. Who will that help if, one, farms are still not hiring people? If you look at the non-performing loan side, they're still going up, which means businesses are still struggling regardless of inflation. And then the third point is employment is not happening and growth is not happening. That combination is not a good one, regardless of the fact that, yes, people want moderate inflation. So moderate inflation is acceptable. Very low inflation itself can actually suggest it's a symptom of weak demand in other areas of the economy, and that's not good.
And banks, as we have been reporting, are also reporting lower lending.
Yes.
So that means people aren't going, to the banks to borrow money.
Yes, and for that, to be honest, the responsibility lies with the central bank. So the Monetary Policy Committee still has the interest rates at about 12.
Yes.
Now, which means banks' onward lending is actually affected by that rate, by that policy rate. So what that means is a bank has no reason, if it can buy a bond from the government of Kenya, gets, say, 14–15%, why would it lend to a business? Businesses will also not borrow at those rates, at the same time as the fact that they will not employ people because business expansion is not taking place. So what we are seeing is not a good policy story. And it's suggesting to us that at the Institute of Economic Affairs, we thought right from July that the the first meeting of the Monetary Policy Committee in August should have reduced that interest rate from 13% to 10%. Of course, they reduced it by 200 basis points, 0.25, and then they reduced it back to 12. Monetary policy is too tight because you need monetary policy at 12% if you're dealing with inflation. Inflation is already at 2.7%. Why is it still that tight?
Right. Okay. So that's an interesting picture. And, you know, as we're talking about even incomes, those incomes have been hit by taxes, and Rose, you were talking about that. So let's talk about that for a minute. We've seen incomes are falling, and we can possibly just play that again so that we have perspectives both in private sector and in public sector. By the way, they've been falling from, I think, around 2019. 2020, we can call it an aberration year because, you know, COVID. But from 2021 to 2023, in both public and private sector, incomes have been shrinking. But now they're shrinking even more with the high taxation, or in fact the new taxes. So talk to us about that and what, in your view, that does for the state of the economy.
Definitely, when there is less disposable income, it means that people will not go. It's actually almost like a chicken and egg situation. So you start off with what Kwame was saying, so looking at it from a business perspective. So the first thing to always recognize is that government does not generate revenue. You know, revenue gets generated by businesses because they then manufacture something or they sell something and they make money, they employ people, and then they pay taxes. Right? So when you're in an economy where there is no access to credit, that's the first thing. I was actually looking at a Kenya Association of Manufacturers report where 70%, which is the third quarter 2024, are not planning on making any investments of the manufacturers are not planning on making any investments at all. About 12%, only 12% have any positive sentiments that they're going to grow their business. The other 44% just have negative sentiments, or they also, about 50% are also looking at reducing their employees or their payroll costs. So what that happens, and I think I've been seeing people doing numbers of an example of somebody earning 100,000 shillings. You have affordable housing levy at 1.5%. You have the social housing authority at 2.75%. Right. We know that NSSF went up at the beginning of the year. We know that pay as you earn, for anybody earning over 500,000 and people earning over 800, there were changes. When you look at that total, pretty much over, I would say maybe almost between 35 and 40% is actually going into really payroll taxes. And so you have a reduction in your take home. When you have a reduction in your take home, it definitely means that you're really focusing on your basic items. You know, you're not going to go out, maybe eat out at restaurants or do anything of that sort, which then now means that that money is also not circulating within the economy.
What is the knock-on effect of that? So if you're making tough choices in a household, for instance, maybe you won't eat out, you won't spend on this, that affects VAT and, perhaps other taxes as well.
Yes, definitely. That has a direct impact on VAT, which is a direct tax, a consumption tax. So that means that the government is actually collecting less. You go back to the employer who is having to watch their payroll costs very carefully, which means that things like pay as you earn is also going down and so forth. So at the end of the day, what KRA is collecting is actually, from an effective point of view, is actually less than what they could have collected maybe if the taxes were lower. So it really has a knock-on effect on, one, the consumer, on the collections the revenue collections by the tax authorities.
Yeah, and I think we were talking, Solomon, about when we started this conversation about what's to come, because there are those 4 new proposed taxes. I mean, obviously, the government had a big hole to fill based on their projections that were not met when Finance Act 2024 was the bill rather was abandoned. But so what are those then projections? It's what, 174 billion shillings that they're looking to
170
collect?
billion.
170. Yes. But, just perhaps explain to us about these laws and, what's to come, because we're already hearing some rather dire grim statistics here from SHIF, from affordable housing. But, are we set to tighten our belts even further, if that's at all possible?
Thank you, Yvonne. So what was introduced recently are 2 laws. Number 1, there's the Tax Laws Amendment Bill 2024, which in part seeks to address the gap of around 177 billion that the government is looking to fill. And then there's another one about tax procedures, but I'll pack tax procedures for now. So when you look at the Tax Laws Amendment Bills, we could categorize it broadly into 3. So there's income tax, there's VAT, and then there's excise duty. So before I go into what specifically is being proposed, when you look at the trend over the last 3 or 4 years, you'll notice that income tax contributes at least half to the total tax revenue that the government generates. And that is followed by VAT, which contributes maybe a quarter to a third. And from that statistic alone, you can draw an inference. So given that a huge proportion is going to income tax, it means that the amount that is available to spend automatically reduces. I would talk about an ideal situation. An ideal situation is where a person like me and you, being the final consumers, effectively pay VAT. And if there's more spending, then VAT will tend to go up.
Yeah.
Now, if you go to the specifics around what is being proposed in the Tax Law Amendment Bill, it's not really that different from what was contained in the Finance Bill. So, and I want to start with the employees first, because in my view, there are quite a number of things that stand to benefit them. Number 1, we'll talk about the one that is causing a bit of grief, that is SHIF and Affordable Housing Levy. Remember, at the moment, these 2 levies are being deducted from your gross. So you calculate tax first, then you deduct the SHIF and the Affordable Housing Levy. So effectively, your disposable income reduces by that amount. So what the bill is proposing is to bring this to the top. So if I'm earning 100,000, for example, then I take a deduction of 2,750, being the SHIF.
SHIF, yeah.
Then I take another deduction of 1,500,
right,
being affordable housing.
Yeah.
So if you round up that figure to around 4,300,
yeah,
then I have around 95,700 on which I'm supposed to compute tax on. So if you do a rough estimate, then my disposable income would effectively increase by maybe 6 to 10%. And that in a way tries to cushion that pain that you'll feel right now when you're taking the deduction. The others really are focused on the employer, given that they are saying that, and there's one thing I forgot to mention. For those who are contributing to pension, and NSSF is one of those, currently you have a tax deductible limit of 20,000. So that first 20,000 is usually considered tax exempt.
Yes.
So they want to increase that to 30,000, which in a way helps in increasing the disposable income. The others really are focused on the employer, given that they are talking about things such as food, where they want to increase the tax-free component to around 60,000 per year. But if I shift to VAT, remember, if you look at the medium-term revenue strategy, there's a lot of pressure on government to reduce tax expenditure. And when we talk about tax expenditure from a government perspective usually comes in the form of exemptions. So if you looked at the VAT Act, there's quite a long list of the items that are considered exempt, and government is actually tasked in reviewing that list so that it is reduced. So when you look at the Tax Law Amendment Bill, I'll just pick one. which I think will be significant, especially for the agricultural sector. So currently, pest control products and fertilizer is zero rated. What does that mean? If a product is zero rated, it means that if I go and let's say buy packaging material which has VAT, then I use that packaging material to package the fertilizer, then sell. That 16% I paid that supplier in buying that packaging material, I can deduct it against my output VAT. Now,
and that means what for eventually the consumer?
You remain in a neutral position.
Okay.
Now, the bill proposes to move that from zero rated to exempt. So on the face of it, it may look that I'm not paying VAT, but in the real sense you are. And the reason I say this is I've bought the packaging material at, let's say, 100, so I have incurred 16% VAT of 16 shillings. Then on this side, I'm selling my fertilizer on an exempt basis. When a product is exempt, what that means is that 16 shillings that I paid for VAT, I cannot offset against any output that I may have because that fertilizer is exempt. What does that mean? As a person in business, I'm there to sustain it. So you either make a choice. Do I absorb that 16% as a cost?
You'll pass it on.
Or do I pass it on to the end consumer?
Yeah, and
chances
you will pass it on.
It will be passed on to the end consumer, and that effect has of increasing prices.
Yeah.
So will the farmer be able to maybe expand the acreage within which he can farm and produce more? Maybe not. And that speaks to what my colleagues Kwame and Rose are saying. When you talk about, I'll talk about multiply effect.
Yeah.
If I have money and I want to farm, maybe I'll employ somebody who I pay money. Then that person will go and buy food for it, and that money continues circulating. But if there's that squeeze, then it becomes difficult for...
Well, so it would seem like it's sort of give and take with that one. So you know, sort of give with one hand and do with the other. What we've said around this table is that you know, reduced income, disposable income means reduced spending, which means reduced collection of taxes by government. So, Kwame, what is that sweet spot for taxation that you know, enables us to pay taxes because we've got obligations, right? We've got debt to pay, which is a first pay. We've got pensions, you know, we've got development, we've got salaries to pay. So we have these obligations, but at the same time, we obviously need to raise taxes. I think there was one elected official who was asking Kenyans, what do you want? You know, you don't want the taxes increased, but you want services provided. So what is that sweet spot for taxation that ensures that it is affordable for the Kenyans being taxed, but that the government is able to make the money to meet its needs?
Okay, so it's in my view, it starts from the new revenue proposals that are being brought back after the rejection of the Finance Bill 2024. Remember, they had good, bad, and ugly things. And because of government communication and arrogance, all the way from the top to the bottom and into members of parliament, Kenyans rejected the entire lot. So there was no call to reason. We have a new cabinet secretary, and I think he thinks that using different language, this can be sneaked back, and so it can be tamed and perhaps can be. Maybe so. But my view, our view at the Institute of Economic Affairs is that rejection suggested that Kenyans know that with falling incomes and lower public service delivery, it's too much to ask for raising taxes aggressively at this moment. And what that requires is for us to re-examine the joint program, the IMF program that Kenya is on regarding the fiscal deficit, the primary deficit. Because it's on the basis of that deficit that these growth rates and these taxes are being generated.
Right.
So Kenyans say that, look, some of these things are unrealistic. Can they be adjusted? We think they can be adjusted. And so we need to revisit that question, because what happened is that these fiscal deficits, these primary deficits have simply been rephased from now into 2025 and then into 2026 and 2027. And we all know, getting us very, very close to elections and whether that will happen, it's a very delicate issue. But I think we need to ask ourselves, fine, this is the position. People live on this income that is falling. inflation is falling on the other side, affecting government's income. And if inflation falls and interest rates remain as they are, then what that means is the growth targets that we have, based on these same numbers, are going to just make this another difficult thing. So I think we are brought back to ask ourselves, are the fiscal parameters upon which this program is based realistic?
Can they be renegotiated? It would seem that, that process of renegotiating, because we know even this current review has delayed for, a couple of months. But are we able to renegotiate and sit down and say this is...
What worries me is that in June and July, it showed us that the tolerance level for high taxes by Kenyans nearly broke the country.
Yeah.
And that should have asked somebody to ask ourselves, okay, what about this? And we thought that those primary deficit numbers were unrealistic. Remember, at that point, it was just an additional 1.7%, right? And we had a party that was speaking about new big projects and that. I'm not saying it's an easy situation. I'm simply saying if we try to ram through the same tax proposals through Kenyans again, and then we get a replay of what happened in June and July, it will show that we have learned nothing. So it's upon us to face and say, look, we owe money. There are things that the fiscal deficit numbers, the primary deficit numbers, in our view, is too tight. That's on the fiscal policy side. The monetary policy numbers as well are too tight. Government needs, the Monetary Policy Committee needs to reduce aggressively the interest rates. Why? So that banks may start lending to businesses for expansion and employment. Otherwise, we are caught in this place where no employment is taking place, taxes are rising regardless, people are feeling the pain, and all you can tell us is that inflation is at 2%. Who cares if they can't eat?
Absolutely. Look, in the private sector, Rose, where you sit, when you look at, these numbers that are being given, what for you remains the solution? Because one of the things we're hearing is we've, managed the interest rates. That then brings down the value of what we owe because, our debt is dollar denominated. So at 129, where it has stuck for, quite some time now. The thing is, what are you seeing in the private sector? Because there are some who say, if you introduce heavy taxation year on year, that, you squeeze people and businesses too fast. And I think I remember, in the lead up to Finance Bill 2024, there was conversation about, okay, increase taxes in one financial year, pull back maybe a little bit and wait to see how that performs and how, because, there's taxes that you put down on paper, but there's also human, behavior towards that. What do you think would be the way to go? Do you increase taxes for one financial year, wait maybe, 2-3 years, and then, then try to review it upwards again? Is that the way to go? But also, do we have that luxury, considering our debt obligations?
We're truly in between a rock and a hard place. I think early this year, we finally passed the national tax policy. And part of what private sector has always wanted is predictability in taxes. Because that whole thing of your taxes are 1.5% this year, next year they're 3%, the other year, then that tax is not working, then it gets scrapped.
And businesses don't plan every year. You do what? Yes. Medium to long term?
You actually do medium to long term, but you also do an annual budget. So by the time you're planning, and I remember a lot of businesses do their planning around fourth quarter, which is October, November, December, which is really the budgets for the coming year. Yeah. Now, all these taxes and changes usually happen July 1. So you've already done your budgets. July 1 comes, and then there are changes in numbers all through. So really throwing things out of work. So predictability in numbers is really, in taxes, is very, very important in all tax measures. But I think that the key thing as well becomes access to credit. Small businesses do not have access to credit. As you've seen, banks are pretty much putting their money in treasury bills and bonds. and are not willing to take that risk to go and lend to a small business while you can actually earn your 16, 18%. From treasury bills. Secondly, the treasury, as they're looking at these taxes, you really have to think about a business. What is going to incentivize that business to grow? Is it reduction in some of the raw material taxes, reduction in some of the levies?
Where do you see that? What would be the incentives for private sector to spur business?
So those would be some of the incentives. Reduction in some of the levies for importation of raw materials, reduction in some of the, let's say, even the employment taxes themselves as well. But primarily, access to credit becomes so important. So I think those are I would say that really the three things that will actually spur growth.
Yeah, but help me understand, Solomon. It is the same government that comes to the market, right? I mean, these treasury bonds are government bonds. So it's government that comes to the market and says, we want money from you, and we're willing to, and they're the ones who dictate the rate, no? I mean, just from a simple understanding. So government comes to private sector, and says, we want this amount of money, and we're willing to give you back interest at this rate. 18%, 16%. I mean, I think we've seen some of the highest interest rates being offered. And then it is the same government officials that will then say, look at the banks, they're being exploitative. They're making a lot of money out of the treasury bonds. So what do we do? I mean, because that's how the treasury bonds and bills work, right? It's government that comes and says, this is what we want and this is how much we're willing to give you. Yeah. It's also the same government that sets the monetary policy.
And
which puts the
maybe this speaks to the point that Kwame was raising earlier around looking at how to manage the fiscal deficit. So as an investor or as a bank, if the government is offering me a T-bill or a T-bond at 17 or 18%, I think we could say it is common knowledge that when you lend to the government, it is usually risk-free. So I am more or less guaranteed that I'll get my money back.
As compared to when you lend me?
Yes.
At a much lower rate?
Possibly.
With higher chances of default?
Yes, and this speaks to the concept around crowding out. The moment I lend, I move this money from the deposits I've taken from you to the government at a premium price, then it means this same money that I would have lent to the private sector or to the SMEs, which constitutes around at least 70-80% of our economy, these SMEs are unable to invest. And as Rose had said, when we were having this discussion before the interview, when manufacturers say 70% of the population interviewed do not see themselves investing, when a person invests, more likely or not, they tend to borrow from someone. That someone could be a bank, could be a DFI, could be anybody. Now, the fact that I am unable to borrow means that that employment opportunity that I would have created by setting up that manufacturing plant goes away. If that goes away, those people would have employed, they don't receive any employment income. And that will translate...
So pay
will go down. VAT will go down. If I'm to import, VAT in a way also is impacted. So
even excise duty, no?
And excise duty.
Because if you are buying soft drinks, bottled water and alcohol,
So if that money is refocused from government securities to the private sector, then in my view, that will really help in spurring economic growth. Yeah.
And this is what we mean, Kwame, when we say there's not enough cash in circulation. Like, what does that mean? Because people say, hakuna pesa kwa economy, but what does that mean and what causes,
Well, I think when people say that, usually it's because monetary policy is too tight. Monetary policy is too tight means this, that the central bank rate or the bank interest rates are so high sometimes it happens. It's useful when government is trying to wipe out inflation.
Yes.
You raise it so that more money can, mop up inflation, as they call it. But the situation we have today is one in which interest rates are that high. Inflation is almost close to zero. I mean, well, close, I mean, outside target. And we still insist on keeping it there. And what's happening is banks, because they have responsibilities to their shareholders and they have responsibilities to the people whose deposits they've taken, ask themselves, what's the best way to actually use this money at the lowest risk? And they sell the bonds to government. Now, government doesn't usually set, well, it's stated in Kenya, I don't think the system works perfectly, but in Kenya, it is stated that it's an auction. So government says, I'm going to, I'd like to get this amount. And then, of course, out of the auction, and there's some bidding. Whether it's a perfect system or not is actually questionable. But nevertheless, a number comes out of there, and government says, look, we took this share of it. Every time government receives that money, it's money that's not available for a private sector person to invest. Because, yes, now let's hope government invests it well, but if they go back there and buy a stadium, for instance, maybe that's not going to generate the growth that was required. And but that's what, so there's that competition for money. And in Kenya right now, government is winning that competition hands down. And then what happens is businesses are in a situation in which they can't invest, because if you're going to borrow money and you have to pay at 16%, the first thing you have to ask is, what kind of business would this be? Your risk levels are extremely, extremely high. The kind of people who borrow under those are people who are either in monopolies or people who are in different kind of businesses, some of which are not very legal. So that's it. So this competition for cash, government is winning hands down. And that's part of the conundrum that we have. I think the time for the Monetary Policy Committee to ask itself through the Central Bank, is this an equilibrium? Is this what we want to do? As that is happening as well, because interest rates are so high, you can see non-performing loans are also growing.
Right, yeah.
That by itself is not necessarily a good thing.
Okay.
So in our view at the IEA, it has to come from that monetary policy being loosened. Of course, it will have consequences. Yes. It's not like a free get out of jail card.
Right, yeah.
I mean, the Kenya shilling might depreciate, and that has implications for debt servicing costs.
Absolutely.
But that is essential for business activity to resume. Okay. Because what we have right now is very, very weak heartbeat from the private sector.
Yeah, let's take that pulse when we come back. I want us to take a very short break. When we come back, I want a closing comments and thoughts on the way forward. I mean, you know, what do we need to do? Kwame, you've already given, some insights into what needs to happen from, the part of the CBK, but also just to get some closing comments. What would the private sector want? What do you want to see in the tax policies that are coming? And how do we get out of this one? Or is it just one of those we bite the bullet? If we're going to do that, then how long do we do that for? And what does the light look like at the other end of the tunnel? So where are we? There we are. Let's take a break. When we come back, we'll have some closing comments from our panel here tonight on the stage.